Hey, good morning once again, options traders. Happy Friday to everyone. And I got a question from one of the traders in our group asking, what's the difference between a buy right and a covered call? And I like this question because if you ask most people, they'll say, there's no difference. They're just two different names for the same strategy. That might be true, but in most cases, it's not true. And it really just shows how a very slight change in the perceptions can make a very big difference in the outcomes and in the risks you're ending up taking. So let's go find out more. What is the difference between a buy right and a covered call? And as always, before we do, please be sure to click like and subscribe. It is greatly appreciated and definitely helps to promote the channel. So let's start off with a couple of definitions of each strategy, just for a little refresher. I do have other videos in this forum here on covered calls. But the covered call is a very popular strategy, and it's one where you start out by owning 100 shares of stock. Now, obviously, you can own more than that. If you own 300 shares, you could do 3 covered calls. 1,000 shares, you could do 10. But this is just the bare bones minimum. You got to have at least 100 shares. And then what you would do is to sell one call on the same underlying. So in the business, we would say you have sold one call against these shares. So for example, let's say that you own 100 shares of Microsoft trading for $450. You've got them in your account, you've had them. It could be even a few weeks, few days, it could be years, but you've got them in your account. And so you want to use a covered call. And so you sell one, let's say an August 460 call trading for $5. And this would be a covered call. Now, what you've done here by selling that call is you have the potential obligation to sell your 100 shares for the strike. So in this example would be for $460. No matter how high the price of Microsoft might rise, you are obligated to selling it at $460 if the long call buyer, that's the person that bought the call from you, decides to exercise. And of course, they're not going to exercise unless it's above $460. That's why I said it's a potential obligation. Another thing to understand with this strategy is that it is neutral to slightly bullish. Selling a call by itself, what's called a naked call, is bearish. And unfortunately, a lot of traders say, well, I'm selling a call, therefore I'm bearish. Well, you're selling a call, but you also own the shares. And that greatly changes things. So the risk graph for a covered call, this one in particular, would look like this. So you can see we've got our bend at the 460 strike. Remember, we always get a bend at each strike price because we've only got one strike in this strategy. We've got one bend. The maximum gain in this example would be 15. Now, why 15? Well, remember, you bought the shares, or at least they're currently trading for $450. So they could rise up to that strike of 460. That's $10 plus the $5 premium that you received. So the maximum you could make is 15. However, keep your eyes down here. This is where the risk is. See, everybody thinks that the risk is up this way, that you end up selling your shares for below market price. The stock rises to 465 or 470, and you have to sell them for 460. That is not a risk. It's an opportunity cost. It's a regret. It can go by a lot of different names. Just don't call it a risk. Because if you do, you're going to start seeing strategies backwards. This is the very best it can do. You knew that going into the trade. Why would you think the risk is to have the best outcome? But they are still trade-offs. You are definitely giving up the upside, the unlimited upside, and you're accepting the unlimited downside. So if we overlay the shares currently trading for 450, that would be the risk graph for long shares of stock. And now we can see the main reason for doing a covered call. It is to reduce this downside risk, in this case by $5. That's the premium that you received from selling that call. That is the main reason for doing a covered call, is to hedge the downside. So in most cases, the downside hedge is going to be small, but always remember that's the main reason for using the covered call. So choose your strikes carefully. You don't want to go sell the $500 call for 10 cents and say, wow, look at the maximum gain I could get. Well, yeah, but that's all from the stock. None of it came from the option. This is why most professional traders will lean towards selling at the monies, maybe even in the monies. If you're dealing with higher price stocks and or higher volatility stocks, you can definitely get away with selling them further out of the money. Just make sure that you're getting a good balance between the return and the downside hedge. Okay, so that's the basic overview of the covered call. Now let's take a look at the buy right. Now again, a lot of traders will say it's just another name for a covered call, and it really depends on a lot of assumptions. The buy right is simply the simultaneous purchase of shares plus the sale of a call. You can execute both orders at once on your broker's platform, and it's typically called a buy right. So again, let's say that Microsoft is trading for $450, and let's say that the 460 call is trading for $5. So you could go into your broker's platform and place an order. It's usually called a buy right screen. Most of you know that your broker platforms have certain sections, where you can do a vertical spread or strategies. They allow you to put in certain types of orders, and it's usually called a buy right screen or a buy right order. And let's say that you enter the order to buy 100 shares and maybe sell one of the 460 calls for a net debit of, let's say, $445. So where's that coming from? Well, if you buy the shares for $450 and you collect $5 from selling the call, the net amount that you would pay, called the net debit, would be $445. So this is a limit order. Might also show at a limit of $445. You could also do a market order, but as you know, that could be a little bit less or a little bit more. If you enter a net debit like this, it may not get filled. If the stock happens to ramp up or call price drops or something and you can't get it filled for $445. But this will assure that you pay no more than $445. So that's the buy right. And after it's executed, yes, you do end up with a covered call. And this is why traders say they're exactly the same thing. Who cares that you put the order in simultaneously? Well, that's not necessarily true. And if not, what's the difference? Well, the real difference between the covered call and the buy right comes down to the assumption of risk. So if you own shares, you are already assuming the downside risk. It's like you've already proven it. Are you comfortable holding shares of Microsoft? Yes. I've had them for the last 6 months or the last 10 years. They've been in my account. I would be holding them even if options didn't exist. Well, that tells me that you're comfortable holding the downside risk. You're already assuming that risk. And if you turn around and sell a call, it reduces that downside risk by the amount of the premium, like we saw on an earlier slide. However, and this is the big however, this is not necessarily true for the buy right. So let's go back to say that Microsoft 460 call is trading for $5. This is usually how traders end up getting into a buy right. They look at this call and they go, man, that's a really big, fat, juicy premium. I'd love to sell this call, what's called naked, by itself. I don't want to buy the shares. I'd love to just sell this call and grab that premium. But if you sell that call, this is your risk graph. So there's our bend at the 460 strike. Our maximum gain is now 5. The maximum you can make from selling an option is the premium. So we sold it for 5. But take a look at this risk graph. You have unlimited risk to the upside. And this is usually what makes at least the smarter traders say, you know what, I'm not real comfortable with this. This is a potential train wreck right here. What can I do to eliminate this risk? Well, one thing you could do is to buy the shares. But when you do that, it's going to flip your deltas. All right, so time for a little bit more of options theory. You've heard me say so many times before, calls or puts, puts or calls. So if we have a short call, I can hedge that with long deltas and make it a short put. So if I buy shares, those are my long deltas, I'm going to flip my risk graph to this. This is what we started off with. This is the covered call. Remember, a covered call is synthetically the same thing as a naked put. That's what I just said. A short call hedged with long deltas becomes a short put. Calls are puts, puts are calls. But notice the difference here. Prior to doing the buy right, you didn't have this downside risk. But after the buy right, you do. So do you see the difference now? So the big thing to take from this, the summary, is that covered call writers are hedging existing downside risk. They've got the shares in their account. They would be holding those shares even if options didn't exist. The sale of the option is for risk reduction. However, buy writers are introducing downside risk. They are risk seeking. Now, is it possible that somebody says, I want to buy Microsoft, I'm going to hold it for 10 years, I don't have any shares now, I would like to do some covered calls against it, let me enter a buy right and just knock them out at the same time? Yes, that's possible. It's just not often how it's done. Usually the reason for doing the buy right is that traders have their eye on that naked call. They really just want to be an option seller. The purchase of the shares isn't necessarily to do this long-term covered call. They are doing it to become an option seller. They just don't want to sell the call naked. But what a lot of them don't realize is that now you're just selling the put naked, mathematically speaking. So it all comes down to, are you comfortable holding the downside risk? And that's the big question that you have to ask, whether you want to do a covered call or the buy right. So even though you could make an argument that there are two different names for the same strategy, depending on the assumption of risk, they can be quite different. So the main thing to remember, options have many moving parts. Strategies that may seem identical on the surface, such as the covered call and buy right, may actually be closer to opposites. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.